Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. There are a lot of things happening in the markets currently. US yields have been shooting up as the Treasury issuances increases. Adding to that, we have the broad risk aversion sentiment after the credit downgrade. This led to a good sell-off in equities all over. And as one of the investors I follow, Mr. Michael Cow says, the US dollar wrecking ball was in full action. From euro to gold, everything was down against the US dollar. On the rates front, Brazilian central bank cut rates. It started its rate hike journey from 2% and had a peak rate of 13.75%. And currently the rates stand at 13.25%. Good morning, JK. There are a lot of things cooking in the pot of financial markets. Keen to hear your thoughts.
Good morning, Swaraj. Yes, I think start with the monetary policy, of course. We had, yes, as you said, Brazil central bank cut their benchmark interest rate by 0.5% to 13.25 from 13.75. Market was expecting only 0.25% lower rate. Just to put a perspective, Brazil had raised rates 13 times starting in May 2021, and from 2% to 13.75%. But they had been one of the most aggressive rate hiking central bank in the whole inflation scenario. Also, we had this Bank of Thailand raising interest yesterday to a 9-year high on Wednesday to 2.25%. So we actually in a situation where monetary policies are quite diverging among various central banks. The major central banks of Europe and US are trying to find a peak for their rates, and then UK is still on hiking path, and EM markets are generally moving towards a pause or even a cut. And Thailand, of course, stands out. Speaking of monetary policy, UK MPC will be announcing their decision today at 4:30 p.m. India time, and contrary to earlier expectation of 0.5% hike, now the expectation is for a 0.25% hike after their inflation eased last month, and that should be a relief. Of course, that's also a relief for the GBP bears, because the GBP was going one way, and that has had a very decent correction. What the central bank will be looking to see is how the economy reacts to the various hikes that they have done so far. Therefore, the future policy moves and the quantum thereof would depend on how the economy performs. But of course, yesterday was a very active day, and for a change, it was a very active day for the INR as well. We have been sharing for quite some time now how the narrowing ranges in the INR and also the fall to multi-year lows of the implied walls indicate a big move in the offing. And that's what we saw yesterday emerge after the global and domestic negatives pushed the rupee quickly to a near 1-month low of 82.80 in offshore trades. On the global side, we had a risk aversion takeover after rating agency Fitch downgraded US long-term ratings to AA plus from AAA. Of course, S&P has already kept US on a similar rating since 2011. Therefore, this ideally should not have been a shocker. But Fitch action has actually served as a reminder for the ticking fiscal bomb in the US, and their deficits are increasing every year. And the funds and the money management fiduciary charters have no longer actually require a top rating to invest in sovereign bonds. But then the government of US will have to be, take some structural measures to see that the fiscal deficit is contained. Otherwise, there will be a larger fallout in going forward. And because US depends to a great extent on the overseas funding for their deficits, and this means that the dollar cannot be so strong, and they will have to keep the dollar at an attractively low level for overseas investors to be attracted to invest in their bonds. But this is something that we'll have to see in the medium term. But in short term, the US bond yields increasing due to huge supply concerns is really the one which is moving the dollar higher along with the risk aversion, because the rates moving up also puts mainly the tech stocks and interest rate sensitive stocks on a negative side. Therefore, the stock markets were down, risk aversion was in full force, and that supported the dollar along with the rise in yields. Both the 10 and the 30-year yield, the long long end have been actually moving substantially. The 30-year was at 4.19 and the 10-year was at 4.09, and the target for them look at 4.30 and 4.40 respectively on a technical basis. So all this has actually led to the rupee breaking the resistance of 80 to 50 with ease, and that set of importers jumping into hedging, apart from stop losses getting triggered for the traders. FI flow was also negative. So we are at the top end of the multi-month consolidation range in rupee at 80 to 80, and that and should the global cues worsen, we will not be surprised to see it break the upside and test 83 or even 83.30, the all-time highs. We will, however, watch the central bank reactions on attempts to break 80 to 80, as they have been content to keep it in a stable range. I'm personally biased to see some more weakness, but I will remain nimble looking at the central bank's policy. On the data side, ADP employment was the only focus yesterday, coming in at 3,24,000 versus 1,89,000 forecast. And that also added to the dollar strength, as well as the yields going up. As for other currencies, euro broke the support at 1.0950 with widening differential with the US on the 10-year now at 8-month high. Japanese yen caught between risk aversion and higher US yields. GBP, of course, as I said earlier, seeing good profit taking ahead of MPC. The Chinese yuan has ignored the measures announced by government cutting taxes to boost consumption, but reacted more to the rising US yields. China has the widest differential with US after Japan. The German yield curve in the meantime has reduced its inversion, and it's once again because the long end yields are going up everywhere. We have a slew of economic data awaiting in US session today, with more on jobs market to keep the traders busy. Of course, I will be more inclined to see how the services PMI pan out both in Europe and in the US, because the service sector has been holding up the economies very well. Finally, the Brent futures were down sharply yesterday, some relief to the Indian importers, currently 2.5% down, and that is because of the overwrought conditions as well as the risk aversion that came about. Technicals are indicating some more fall in the crude prices, but really the focus is on how the risk sentiment pans out in the coming sessions with the US dollar strength and the US dollar yields going up. Thank you.
Thank you, JK. And the theme of the day was the broad risk aversion that's ongoing in the markets, especially when we see most of the currencies being battered because of the dollar strength. Even the Chinese yuan was beaten down, irrespective of the somewhat stronger fixing, but at the same time, the efforts by the government to boost consumption. INR is testing somewhat of the higher end of the range because of this broad risk of sentiment. And as JK mentioned, we will be nimble to assess how things move going forward. Today we have the UK MPC rate decision, and 25 basis hike is expected against the 50 basis hike earlier. That's it from us today. Thanks for listening, and tune in tomorrow for another round of fresh updates. Thank you so much.